Hello and welcome back to the complete day trading course by Wealthy Education. In this video, I'm going to have a few words about short selling and short squeezes. First of all, I have to explain what short and long are. Short and long are ways of identifying a position. Long is probably what you most understand. That's just simply owning something. In this case, I've got an Apple daily chart in front of you. Buy it anywhere here. As long as you're in the market, you're still long Apple. Maybe 100 shares, 1,000 shares, 1 share. It doesn't really matter. Now, to be short something is to try to profit from the value falling. And in the stock market, you go out, you borrow shares from a broker somewhere, and then you turn around and sell them to somebody else. The idea is you can buy them back for less. So say you sell them for $500 and you turn around and you buy them back after it's fallen in price to $400, you get to pocket the $100. Now, obviously, if the price rises, it goes against you and you have to buy it back at a higher price. There's an entire situation behind borrowing shares. Not all shares are easily borrowed. So there's that. But if you're sticking with liquid stocks, which you should be as a day trader, it's not too hard to find shares to short. Most of the time, your broker will carry a certain amount of them. So long is your owning, short is your selling. So there is such thing as a short squeeze. And a short squeeze is quite often seen around earnings. It doesn't have to be, but a lot of times it is, or some type of news. And what happens is you get far too many people negative of a stock. They've been shorting it for some time. Some good news comes out, turns everything around, and the stock takes off. It's not necessarily the easiest thing in the world to identify, but it's essentially what it is. It's simply a sharp move higher. So it really is kind of neither here nor there, but you'll notice earnings came out right here, and then the market just shot straight up for Apple. Earnings here shot straight up. So anybody who's short of the market right there is trying to cover, meaning buy. So let's just say you shorted here. Market's going your way for a while. Earnings come out, or news, some type of catalyst, and the market starts doing this. Well, your losses are piling up because if you think about it, a short seller could, in theory, lose an infinite amount of money because price could go, it's not going to, but it could go all the way to infinity. There's nothing stopping Apple from going to $1,000 a share, and if you shorted at 100, that's a major problem. Buyers, on the other hand, the worst it can do is go to zero, and then, you just don't have any money. But it doesn't, it does stop. It has a built-in stop loss at zero. It can't go below there. So at this point, it's a short squeeze. Short sellers have to turn around and start buying shares back. And what will happen is they'll put more buyers in the market, and it will drive price up rapidly. Kind of like what you're seeing here. What's the difference between a surge in volume to the upside and a short squeeze? Well, the quick answer is nothing. It's just there's a catalyst, and it's an easily identifiable catalyst in a short squeeze where you have short sellers jumping ship because of overly good news. You see this more during, again, announcements, during earnings, that type of thing, because there's a reason for that type of move. Otherwise, it can be a little bit hard to identify the exact reason, but at the end of the day, it's the exact same thing. Any massive move higher, even if it's not technically a short squeeze, it has the same effect on the charts.